Okay, let's dive right into this explainer, because we are unpacking a totally shocking reality that has completely flipped the script on the stock market in the first half of 2026. For nearly a decade, there was basically just one golden rule if you wanted massive returns: buy big tech. The Magnificent Seven, we're talking Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla. They were the absolute wonders of the financial world. They single-handedly dragged the entire index upward year after year, honestly making anyone who preached traditional diversification look kind of foolish. But, as we're going to see in this investigation, that era of unquestioned dominance, yeah, it just hit a massive, unexpected brick wall.
0%. Just let that jaw-dropping number sink in for a second. That is exactly how much of the S&P 500's growth was driven by the Magnificent Seven tech giants in the first 6 months of 2026. After years of generating just unbelievable, sky-high returns, think about Nvidia's historic run, their collective contribution to the broader market's growth has literally flatlined. It's an absolute paradigm shift, and it's caught a ton of everyday investors completely off guard.
So, here's our roadmap for today. We're looking at the cash flow problem, the true cost of AI, the ghosts of market past, the return to quality, and finally, your portfolio strategy.
To really put this massive reversal into perspective, think back to 2023. Back then, the Mag 7 drove a whopping 76% of all the growth in the S&P 500. They were doing all the heavy lifting. But in the first half of 2026, almost 100% of the index's growth is coming from the other 493 companies. That's right, the businesses that basically nobody was paying attention to, the ones quietly playing second fiddle for years, they're the ones actually pulling the card forward now.
And Wall Street strategists are picking up on this fast. They're literally renaming them the Lag 7 now, because they're dragging the market down. For the first time in a decade, the market is just flat out refusing to pay any price for these tech giants. Their valuation premium, the extra dollars investors are willing to pay for just $1 of their earnings, compared to your average company, has plummeted to a 10-year low. Their aura of invincibility is gone.
Part 1. The cash flow problem, beyond the margins.
So, to figure out what broke, we have to look past the flashy net profit margins and focus on the real lifeblood of any business: free cash flow. This is the actual hard cash available to reward shareholders through things like dividends or stock buybacks. It's what you get to keep after paying to keep the lights on and the business growing. For years, big tech companies were spectacular machines at generating free cash flow. But something fundamental has completely shifted.
Their entire underlying business models have transformed. We've shifted from a beautiful capital-light era to a really grueling capital-heavy one. Think about it. A decade ago, you could write software code once and sell it infinitely for free, right? The marginal cost was zero. But today, building artificial intelligence infrastructure requires massive physical data centers. We're talking billions of dollars in chips, copper, silver, and enough electricity to power entire cities. The lightest, most agile companies on Earth are suddenly spending cash like industrial steel mills.
Section 2. The true cost of AI. The AI arms race.
This is where the numbers get truly wild. According to data compiled by Deutsche Bank, while the rest of the market played it safe, paying down debt and increasing capital expenditures by a modest 62% since 2019, the tech giants went on an absolute spending frenzy. They boosted their capex by an eye-watering 876%. In some quarters, these companies are pouring 70 to 80% of their operating cash flow straight back into infrastructure. They are literally vaporizing their free cash flow to fund this AI arms race.
And, well, the cracks are starting to show from the inside. When market leaders start admitting that their massive AI investments might actually be outpacing the technology itself, investors rightfully start to panic about all that burned cash. Take Mark Zuckerberg, for instance. In an internal town hall, he reportedly noted that AI progress was moving slower than expected, and they were actually planning to sell off excess computing capacity. So now the market is asking a terrifying question. What if we built 100 data centers only to realize we just needed 60?
Part 3. Ghosts of the past. Market history. You know the old saying, history rarely repeats exactly, but it often rhymes. Well, we've seen this exact pattern play out before. In the 1970s, it was the Nifty 50, companies like IBM and Coca-Cola, that people thought you could buy at literally any price because they'd just grow forever. Then came the brutal crash of '73. In the 2000s, it was the dot-com bubble, with undisputed internet kings like Cisco. Whenever a handful of beloved companies seem like the only logical place to put your money, leadership abruptly changes hands. The giants stumble, and the boring, forgotten companies suddenly take off.
The Financial Times recently compared today's market to the year 2000, and it is fascinating. In 1999, the cap ratio, which measures price against historical earnings, was in deep bubble territory with a Z-score of 3.3. Today, in 2026, we are right back up there at 2.9. But here is the really terrifying difference. Unlike the year 2000, today, it isn't just stock prices that are in a statistical bubble, it's the corporate earnings themselves. Earnings are currently 60% above their historical trend line. If the supernormal profits come back down to earth while infrastructure costs are exploding, the fallout could be severe.
Section 4. Return to quality, finding value.
So if the market is punishing the heavy spenders, where is all that capital secretly going? According to Schroders, the AI craze has completely fractured the market into three pieces. You've got the AI winners, like hardware and semiconductors. You've got the safe havens, utilities and banks where folks are hiding out. But the most interesting spot, a generational opportunity lies right in the middle, in a group they're calling the AI losers.
When the AI panic really set in, investors totally threw the baby out with the bathwater. They violently punished highly profitable software companies, what we call quality compounders, because they were terrified AI would make coding obsolete. So now incredible businesses like Salesforce and Adobe are trading at half the price-to-earnings ratio of the broader S&P 500. Yet they still have massive competitive advantages, super loyal customers, and crucially, they generate mountains of real free cash flow.
Section 5. Portfolio strategy. Prepare your money.
Okay, so how do we actually apply all this to protect our own money? First off, you don't need a crystal ball, and you definitely don't need to abandon your global index funds. A broad market-weighted ETF will naturally self-correct over time as those 493 non-tech companies rise up. But if you want to actively limit your exposure to big tech's concentration risk, you have great options. Think about an S&P 500 equal weight ETF, which gives smaller healthy companies the exact same influence as the giant tech names. Or allocating 10 to 30% of your portfolio to quality factor ETFs, which specifically filter for low debt and high free cash flow, can seriously anchor your investments.
Let's run through a quick financial checkup, because being ready isn't about perfectly timing a crash. It's about making sure your personal finances can survive a 50% drop without forcing you to panic sell. Step 1. Honestly assess your job stability. If your income is tied to the stock market, you need to take less risk. Step 2. Build a strong cash buffer to ride out the storms. Step 3. Make sure your investment timeline is genuinely 10 to 15 years out. And Step 4. Accept the fundamental truth that bull markets always end. It's a feature, not a bug of investing.
So, as we wrap up this explainer, I want to leave you with a crucial question. Take a really hard look at your investments today. Are you relying on a handful of heavily concentrated tech stocks to predict the future for you? Or are you building a financially bulletproof, fundamentally sound plan designed to survive whatever reality throws at us? Don't get stuck chasing the ghost of the Magnificent Seven's past. Make sure you're actually prepared for the market's future. Keep learning, stay disciplined, and thank you so much for joining me on this investigation.